We interact with banks probably more often than any other financial institution out there. Banks provide a broad set of financial services. They safely store our money, provide us with access to the payment system, they give us access to financial markets, and they make loans to creditworthy borrowers. The larger banks are financial supermarkets that offer both commercial and investment banking services all under the same roof. In this session, we are going to focus on the business model of commercial banks. We will describe how commercial banks raise funds, how they borrow, and what they do with them, how they lend. Along the way, we will make the distinction between retail and wholesale banking. Let's start by defining what a commercial bank is. A commercial bank is a financial institution that takes deposits and makes consumer, real estate, and business loans. Historically, commercial banks would cater to businesses. That's why they have the commercial label. But nowadays, they serve households and individuals as well. We usually classify commercial banks according to their size and function. At one extreme, we have the community banks. These are small banks that serve consumers and small businesses in their communities. They take deposits locally from people like you and me, and they lend these funds out locally, also to people like you and me. This is what we call retail banking. In terms of size, they have assets under management. This will mostly be loans under $1 billion. Next up, we have the regional or super-regional banks. These are larger than community banks. They have assets ranging from tens of billions of dollars to more than $1 trillion. They will be headquartered in larger cities and can have offices and branches that run throughout the country. Some are organized as financial holding companies with multiple bank and non-bank subsidiaries. The commercial banking arm of the business operates on a larger scale. We have retail lending, but we also have wholesale lending, which means commercial and industrial lending to large corporate customers. They also have access to wholesale funding markets. This means that in addition to borrowing from retail depositors through branch networks, these banks can also borrow funds in debt markets. I will be more specific about these borrowed funds in just a moment. This brings us to the money center banks. These are mega banks that rely on wholesale funding to support their lending activities. The US-based money center banks are located primarily in New York City, and they sit at the center of the interbank loan and currency exchange markets. Citigroup is a money center bank. Wells Fargo is a mega bank, but it also has the largest branch network in the country. It can easily obtain deposit funding. Wells is a super-regional bank. Commercial banks borrow, lend, and earn the spread. They borrow and pay some expenses on that, and then they lend and earn some interest on those investments. What does this actually mean in practice? How do banks borrow? How do banks lend? Okay, let's start on the funding side. Banks get their funding from savers. They raise deposits from individuals and businesses. To convince depositors to lend them money, banks offer safety and convenience. Banks can also borrow from businesses and other financial institutions through financial markets. This usually requires interest payments. There are two types of deposit accounts. Transaction accounts that include demand deposits. These are our checking accounts. They pay no interest, but we can withdraw our funds whenever we want. Non-transaction deposits include savings accounts and small certificates of deposit. These are savings instruments that usually offer us some interest payment. In exchange, these deposits are a bit harder to access. We might only be able to make a limited number of withdrawals per month, or with a CD, there might be a significant penalty for early redemptions. Borrowing is the second major source of funds, especially for the larger banks. one bank with a funding shortfall can borrow from another bank in the interbank market. This is also called the federal funds market. These are short-term, unsecured loans. Banks can borrow on a secured basis using a financial instrument called a repurchase agreement or a repo. Repo borrowing works a lot like a pawn shop. Let's say I'd really need a few $100 to buy tickets to the next Illini basketball game. I can take my golf clubs to a pawn shop. We all agree that these clubs are worth $500. The pawn shop guy will take the clubs and give me $400. This is a $400 loan secured by the clubs. And then next week, after I cash my paycheck, I can buy my golf clubs back for the full $500. And if I don't show up next week, the pawn shop guy gets to keep my clubs. This is basically how a repurchase agreement works. When banks do this, they post high-quality securities, such as treasury bills, to borrow cash overnight from cash-rich institutional investors such as pension funds. The trouble with repos and other short-term borrowed funds is that they tend to disappear when investors get worried. It was famously observed that the panic of 2007 was a run on the repo market. The volume of outstanding repos collapsed almost overnight. So some banks lost a really important source of funds. Lehman Brothers was a prime example of this. We can classify funding sources in terms of how expensive they are and how runnable they are. Retail deposits can require a large infrastructure and a lot of fixed costs to bring in. However, this funding is cheap on the margin, and because of government-backed deposit insurance, it tends to stay within the banking system during panics. Wholesale funding is the opposite. Banks have to pay competitive rates to attract it, and during bad times, it tends to run away. Bank capital is the last piece of the funding puzzle. This is the owner's investment in the bank. It mainly consists of common and preferred stock. And just like any business, it includes retained earnings, or the profits that are reinvested in the bank. Unlike debt, bank capital never matures, so it is as sticky as it gets. However, because equity is subject to price risk, it is more expensive to raise than deposits.